All right, now I'm going to officially kick off today's program with someone who truly needs no introduction in the Canadian real estate world, but I'm going to give him one anyways. Our first speaker is Daniel Foch, Chief Real Estate Officer of Valery.ca, Canada's first AI-powered real estate brokerage. Daniel is also the co-host of the Canadian Real Estate Investor podcast, which holds the title of Canada's #1 real estate podcast. He is a nationally recognized real estate expert with over 100,000 followers across his social platforms and is regularly featured in outlets like the Wall Street Journal, CBC, and BNN Bloomberg. This morning, Daniel will be sharing a Toronto real estate market update, giving us a data-driven look at what's really happening in the market and perhaps what might come next. Please join me in welcoming Daniel Foch to the stage.
Thank you. Thanks everybody for giving me the time to chat today. Am I good on this mic? Yeah? I'm going the wrong way. There we go. Okay. Good room. Thank you all for coming out. I'll skip the introduction. There's a QR code there. I'll put it at the end, but if you want to download these slides, I just find I go through like 80 slides in 30 minutes, so a lot of people often want to get that, so I'll put that at the end when I'm doing questions. All right, so let's start off with just a broad view of the market here. Pre-construction sales are horrible. I don't need to tell this room of people that. I think a better question is what happens next? And in a lot of these discussions, I talk about how before we were shifting away from this really high cost model of building high rise to this lower cost model of missing middle, where we can deliver housing on a much cheaper basis. Land costs are a little bit higher, but your construction costs are a lot lower because you're building out of sticks. And it seems to be pretty much the only way that actual housing is getting built across the country now. But the problem, and this is what I'm going to go through a little bit today, is that the geography of it is not super favorable to the GTA. And so when we talk about the idea of a housing crisis, it feels like this national level thing, but it really is localized to the two major markets, Toronto and Vancouver. I would actually argue that very much we're building enough housing at a national level. It's just probably in the wrong places and potentially the wrong product type. And I'll get into why sort of the details on why that is. So this is your house price change from peak. I get rid of all of the doom charts off the. People always criticize me for being too much of a doomy guy, so I try and get that out of the way as soon as I can. Pre-construction sales across the country, basically at historic lows, and on a per capita basis. If you when you say historic, you're comparing to the 1990s. Our population is 10 to 15% greater than the 1990s, and so on a per capita basis, we're basically in the slowest real estate market from a pre-construction and resale perspective that we've ever been in Canada. It's bad, okay? We'll get that out of the way. The interesting part is that the real estate industry, realtors, the real estate profession, feels this the most because we're the largest real estate board in the world. We have the most realtors per capita in the world, and the dollar volume of a transaction on a per realtor basis, I don't even have the 24 numbers in here because they were just so bad I didn't want to depress everybody. Number of transactions on a per realtor basis, similar trajectory. And what this has led to, this is a chart from a guy named John Flynn, who's a big YouTuber in the real estate space. Realtors are now doing more leasing transactions than sales. And this interests me because I think that they're really good at anticipating market trends and paying attention to the way that the industry is shifting. They have to be opportunistic. Their income depends on it. And one of the things I'm going to talk a lot about today is how I think the market is also going in that direction, especially in the GTA. We have a record number of rental listings on the GTA, on the Toronto Real Estate Board in the Greater Toronto Area right now. And the lease volume is, this captures the seasonality, so it's a little bit of a bouncy chart, but if you look at it on a year over year, every month this year, we've set a record for the number of properties leased on the Toronto Real Estate Board. We'll talk a little bit about what's happening with lease values, because I think this is what matters to a lot of you on your net operating income, obviously. We know rents are down a little bit. I don't think they're down as much as a lot of people want to imagine. And rent CPI is very much, I have a chart on it from the Bank of Canada, but rent CPI is still reading really high, and a lot of that's because inflation basket comes from people who are also turning over rents and turning over a lease and getting that 2.5% increase. But lease rates are down, and this has a kind of interesting impact on the broader housing market, especially in Toronto and Vancouver, which I'll show you some charts, but it doesn't have a huge impact on markets like Calgary and Ottawa is, I think, another example where I have a chart from in the deck here. I'm just going to skip this one because it's too bouncy. So I pulled out the Toronto line here, the purple line, and one of the things I want you to observe is basically, before the pandemic, there was always a rent premium for units in the 416. And the pandemic broke that, obviously, right? People were moving out, they didn't need to be close to their workplace, and so the 905 was renting comparably on a per unit basis, a little bit lower on a per square foot basis, as the 416. But if you look at the last year and a half, year of data points, 416 is firmly above the 905 on a rental basis, on a rental rate basis. Then this is on a breakdown by unit, or sorry, by area. And this matters to me because we're kind of getting back to the traditional direction that we were in, that sort of we paused during the pandemic. And what I think this means is we're becoming a high renters urban economy, and home ownership starts to get pushed out to the suburbs, and we're really heading towards a renter's economy in the Canadian. It's not that I like this, by the way. I'm not arguing. I mean, I guess John and I argue about this a lot, and you know, I don't really have an issue with it, but it's not the model that I would say is necessary for us to design economy or economically. But it's what's happening. It's what the direction that policymakers are pushing things, and it's the direction that consumers are moving. People are continuing to rent. And there's a kind of distinct reason for that I'll get to when I go through some stuff from National Bank. When I think about this, I talk about the idea of a European housing model. And the easiest way to look at that is Canada's sort of dead in the middle of this chart on housing tenure distribution. So from a home ownership rate perspective, we have, I think we're like 66, 67%. Everybody to the right of us on this chart has a lower home ownership rate. Everybody to the left of us on this chart has a higher home ownership rate. On the left, you see a lot of former USSR, areas that have an influence of communism. It's not to say that communism is obviously correlated with high home ownership, although I guess one could argue that you know, maybe the most capitalistic thing that you could do is financialize someone's basic need for shelter. But on the right-hand side of this chart, you see places like Austria, Germany, Switzerland. And so when I look at this chart, I would just ask you to kind of think about, like, what is the direction that Canada, and more specifically Toronto, is headed from a policy perspective. I mean, we know that Carney is out there hanging out with the leaders of a lot of the countries on the right-hand side of this chart, not so much on the left-hand side of this chart. This is me in Switzerland. I used to live there. I was in the army. I put this in here because I had the lived experience of one of the countries on the far right-hand side of that. I skipped through the slide quickly because my friend in the middle, I couldn't find a picture of him without a cigarette in his mouth, but he's a higher net worth than all of my friends in Canada, and he's never owned his house before. And so in Canada, we have this high concentration of household net worth in real estate, and I think that we're finally going through this shift away from the next generation of people, of occupants of real estate, are going to be less inclined to own and more inclined to rent those houses. The other interesting part is when you compare us to a place like Switzerland, we are typically among the top countries in the world for highest household debt to income. One of the things that I think about a lot when I think about where opportunity is in real estate, because we're buying on like 10, 20, 30 year, 50 year if we're buying with CMHC, MLI Select outlooks, right? We need to think about what the entire macro and Canadian economy is going to look like when we terminate that project in whatever 30 to 50 years. And to me, Canada basically spent, since our last huge rental housing boom, which was the 1970s, we spent since that period of time growing our home ownership rate, prioritizing home ownership over creating rental, and we're starting to see policies shift back in an alternative direction. And my forecast would be that Canada's home ownership rate will continue to decline in the way that it has, and it's already started to decline, basically peaked in 2016, 2017. On the bright side, from an ownership perspective, housing affordability in Canada is improving. If you observe sort of past housing cycles, you'll see this double peak where First peak is house prices getting crazy, inflation gets out of control, central bank cuts or hikes rates, house prices drop. The second spike is from interest rates pushing the mortgage payment up on a monthly basis. And then you see, as they start cutting rates, housing affordability kind of returns into its normal channel. We're still very far away from that historical channel of the cost of home ownership, at least in the city of Toronto. From the same report from National Bank, this is one of the things that I've always found interesting that they observe. They're one of the only houses that does it, is they show the spread between the cost of renting a two-bedroom versus the cost of owning a two-bedroom condo in the same city. And most cities, except for basically Toronto and Vancouver and a couple of others, have corrected that huge gap that appeared during the pandemic. And you can see historically, the costs really weren't that different. Really, the difference between owning and renting a unit was your ability to save up a down payment. Toronto hasn't been able to correct that spread. You look at a place like Calgary, where the market has been a lot less volatile, although it does seem to be kind of plateauing or rolling over a little bit. But we see capital being very comfortable going in there, even with vacancy rates going 6, 7, 8%, is because the market is a lot more balanced from an outcomes perspective in favor of owners and renters. Ottawa would be another interesting example where they had that sort of spread happen during the pandemic, but it seemed to have normalized quite a bit. And the reason this is relevant is Ottawa seems to be pretty stable, like almost starting its the slow recovery, let's call it, after sort of the correction that it saw post-pandemic. And the point of this is that if it's more compelling for people to rent, they're going to rent. If it's more economically compelling for people to rent, they're going to rent. They're not going to buy houses. And this is great for people who are developing rental housing, which I imagine a lot of the folks in this room are. And it's also great for an economy that is beginning to be built around the creation of rental housing rather than the creation of for sale condos, which the shift away from has been incredibly dramatic and very quick. And I have some data on that as well. I'm just going to jump through these because they're a bit, I want to be as quick as I can. This is the rent CPI thing that I mentioned from the Bank of Canada's observation, and then the chart on the right-hand side is from Rich Diaz at IceCap, the Loonie Hour. You see the only reading in Bank of Canada's inflation that's blood red is rent. At the bottom there, you'll see like a one bar that's fully red. But all of us in this room know that rent's falling, right? And rent's falling because it tracks population growth pretty religiously. And so eventually, and this is why I think the Bank of Canada has a comfort level to continue cutting and why they've probably cut so far, is they know that both rent and mortgage interest costs, if you get another 25 basis point cut by the end of next year, or by the end of this year, most mortgages will actually be renewing at a lower rate than a higher rate. So your CPI on mortgage costs will also come down. And so the Bank of Canada can see that in their forecast, and they're saying we're a little bit more comfortable than we would be to cut. We talk a lot about the comparison to the 1990s, and the one thing I want people to observe is that during the 1990s, we saw this organic decline in population. Right now, we have a policy-driven decline in population, but we also probably have an organic decline in population. The economic promise of Canada isn't as what it was when people originally started making plans to move here, and so you start seeing a lot of temporary residents leave, and that has further downward impact on rents. From a price change perspective, if you look at the 1990s, we're tracking pretty comparably. If you were to assume that we follow the exact same trajectory, you've maybe got another 5-10% downside risk on house prices. This is the question everybody always asks me, what's going to happen to house prices? If you want to take a more extreme look, you could maybe try and compare it to the US housing bubble, this is a chart from BMO, and you might say we have maybe 10-15% more downside risk. In regards to the rents falling, because prices are coming down, land costs are coming down. I think a lot of you are probably seeing construction costs coming down, even soft costs. I think the bidding process is being a lot more favorable for the capital side than the labor side of the development process. This means that the rent that you need to be able to make a project viable is actually getting lower, and I guess your interest rates obviously would help that a lot. On the MLI stuff, you're probably seeing 150 bips lower than we were at peak. And this has led to this rental construction boom that the likes of which we on a sheer volume basis, we've never seen before. We've never been building as much rental as we currently are in Canada. On a per capita basis, we're getting back to the 1970s level. Again, population was 20% lower then. Rental apartment construction is basically the largest contributor to total construction activity in Canada right now. This comes from Central One, Brian Yu. He puts out some great reports on this. A couple of these charts are from him. So we're going to have record rental closings. This sounds like scary when I'm telling this to a room of people who probably are hoping to develop rental in the next year, but it's actually not, and I'm going to show you why in a couple of slides. But 88% of rental apartment construction right now is insured or financed by CMHC through MLI Select or ACLP or MLI Standard. So this is policy, basically, like policy was designed to push us in this direction. And it was probably necessary, right? Like we knew the pre-con thing was done. It's probably done for a while. And we needed to backfill that construction activity. It's not like the housing crisis went away overnight, and so we needed to continue creating units. The distribution of this across the country is what interests me the most. So you're seeing certain areas where you have a huge potential increase in housing supply. Kelowna and Barrie are at the top of the list. I would say like they're really small from a existing rental universe perspective, so I wouldn't read too much into it. But like if Kelowna or Barrie doesn't see an increase in household formation or population growth, which fortunately both of them are seeing that, their vacancy rates would increase by the double-digit amounts in a year, and then it would take a while for that to get absorbed. Toronto is basically towards the lower middle of this, where we're building about 5% of our current rental universe is under construction right now. That doesn't account for all of the condos that obviously are going to come on the market, and many of which are going to make it into the rental supply pipeline. So I just wanted to create the context on like sort of where we're heading from policy direction, this shift towards rental. So we have this, the housing minister recently came out and said that the average price of housing must fall to fix the housing crisis, but that we don't want the actual house price. Like everyone in this room, you don't have to worry, you're not gonna lose any equity in your house. Somehow this is gonna work, and it's possible, right? It's just really, it's playing with numbers. It's skewing the averages. If I was tasked with making that happen, protecting everybody's equity in this room and somehow getting the average price of housing down, the first thing I would do is upzone all of the detached properties, which we've already seen happen at a national level, and they did that over the last couple of years, and it's done a pretty good job actually in kind of like flooring that detached market. The other thing I would do is I would build way more apartments and way less single-family detached houses, which is what this chart shows us that we're doing here now. The other thing I would do is I would stop building in Ontario and I would start building in other provinces. And this is where things start to get important and very relevant to you in this room. Because I can build houses a lot cheaper in Alberta than I can in Ontario, and that starts to pull my average down at a national level. Ontario is now at a record level of percentage of total national housing starts. So again, we hear about this housing crisis across Canada. I'm very much of the opinion that it's close to being solved at a national level. We will start having localized housing crises mostly in just Ontario, Southern Ontario, because of this and because the economics of construction make it very difficult. This is what creates what you hear a lot of people talk about, and I was not a believer in this thesis, by the way. 2028, completions fall off a cliff. You've got no new housing, and population's been growing basically between now and then. And the population growth one is obviously waning a little bit. Population growth is going to be negative for probably a year, and then it'll be very low for the couple of years after that. But it's still population growth, and it's still primarily going to the GTA. And so is there a high possibility that we have a supply shortage that starts in 2028? Yeah, I think it's a very, very possible outcome. The other thing I would do is I would change the mechanics of my denominator in my average calculation by building a lot more rental housing and a lot less ownership housing. And these three charts that I just showed you illustrate that's what the government's doing right now. And so they will probably accomplish their goal. I think that the current Liberal administration, the past Liberal administration, they like to put out these headlines where they say this is our target, and then later they can say, hey, remember when this headline was in Global a year ago and we said we were going to do that? We did it. As of 2023, CMHC now insures on an insured in force basis more rental than homeowners. This to me is the clearest indication of the direction that policy is heading. Our housing agency that is designed to create housing and housing affordability is doing that by creating rental rather than making home ownership attainable. Again, it's not a criticism, it's just an observation. I don't really have a huge issue with rentals. That's why I use the model of my friends in Switzerland. Most people in Switzerland rent in urban areas. When they decide they want to go have a family or whatever, they suburbanize and they go own a home or maybe take over the family home. This chart comes from Oxford Economics. They put out an annual. I would encourage all of you to actually get this if you get a chance, and just if you get my contact information after, I can send it to you. But they show the new housing requirements versus the housing starts, and I'm actually of the opinion that we're probably, if not currently, we will be building enough housing because of what's happening with the population growth curve, and because of the massive increase that we've seen in rental construction, that we're building more than enough housing to solve the housing crisis in Canada. The problem is that it's built in the wrong places. It's being built in Alberta and Atlantic Canada. No offense to those markets, beautiful cities, great people, very affordable everything, but it's not where the concentration of Canadian population and concentration of Canadian population growth is. It's the wrong type. We're building rental housing in historically ownership markets like Calgary, or I mean Halifax is a little bit less, but like the Calgary of the world, or even in suburban markets. Like in Ontario, these projects work in markets where your second tier, third tier markets, maybe suburban markets, where historically the primary tenure of housing was ownership. We're building condos in markets that are historically more renter favored. I mean, Olivia Chow won the election in Toronto mostly by playing to the fact that for the first time ever we had as many or more tenants in the city of Toronto than we did homeowners. And this is a direction that policymakers are starting to go, right? Like you used to be able to divide the population into homeowners and renters and very easily win an election by catering to the needs of one of those groups of the population. I mean, New York's another really good example, what just happened there, right? And a lot of this is because you have this different class between homeownership and rents, and they have very distinct and different needs. The other thing we're doing is we're building the wrong size of housing. So we're building very small condos or apartments and very large houses. The solution that the government proposes for this is to start skewing buying power in favor of first-time buyers through things like the GST, HST rebate. I don't think housing should be taxed at all. So, I mean, this is great. I think that it should just not, it doesn't need to be targeted to one specific group. Ontario did the same thing. So now you have a $130,000 subsidy at its maximum for first-time homebuyers who want to buy a brand new house. Caps out at about $1 million, and then it starts to diminish after that. Policymakers, if you want to move the market, you should try and give things to first-time buyers because they're the largest group of buyers. John and I argue about this all the time. I think that first-time home buyers are the most irrational buyers in the market because they're younger, they've never bought a house before, they maybe are more likely to hire a realtor who's never bought a house before. Your Gen Z, broccoli hair realtor does 2 deals a year. And that makes them a less rational consumer, which makes them more likely to overpay for a house, which makes them good at supporting the market when you need them to. As a percentage of the total buyers, first-time home buyers are diminishing and investors are growing. The policy, when it was first proposed, the HST policy, this comes from Desjardins. Their analysis basically showed that they felt that Toronto and Vancouver would see the majority of the benefit of this HST policy. I'm not necessarily sure I agree, except if they're focused primarily on condos. If you look at the federal budget and you calculate the number that they allocated from lost tax revenue for how many people they expect to use this program, you're only looking at about 22,000 buyers a year. If you assume your average transaction is 700,000, that goes down to 15,000 buyers per year. If you assume a 900,000, which is probably more appropriate for the areas where we actually need this policy, like Toronto and Vancouver, which gives you a range of about 3 to 4% of all of the real estate transactions in a year. So again, this isn't something that, from my perspective, is going to massively move the needle, and it's not going to get first-time homebuyers out of renting and into homeownership, especially where they're buying a product where in most cases they can't afford. You see the maximum price for optimal tax benefit. This is Altus's cost curve for your pre-construction units right now, and basically everything is above that line. You do start to see markets where people can achievably bring units on the market, your Kingstons, London, Ottawa, et cetera, where they are seeing a little bit of recovery and a little bit of growth and a little bit of activity in that market. And the reason is because they can afford to bring units to market. Your land cost is lower, labor cost is lower, et cetera. In the city of Toronto, we don't have this luxury of being able to drop prices to the point where first-time home buyers can afford them, at least not immediately. And it seems to be a sort of painful process that we're trying to get through. One of the things, this came from C.D. Howe recently, was that they felt that we needed to see more growth in a lot of these smaller cities in Canada. And I do think this is what we'll likely see happen, is you'll start seeing a lot of this homeowner demand get pushed outside of the GTA and into kind of those smaller second-tier cities, especially in the province of Ontario. When we think about housing starts, historically it tends to track house prices relatively. And the other piece that I think the policymakers are doing right now, and this is the one thing that I think is probably going to have the most impact on the market, I'm surprised a lot of people haven't been talking about it, is that OSFI right now is looking at, they're running 2 stress tests side by side. Are people familiar with this? No? Okay, I'll go into it a little bit. By the way, if you guys ever have any questions, I saw somebody's hand go up, but I think they were waving to a friend. If you want to just interrupt me and ask me something, I'd actually prefer that. So OSFI's running this 450%, 4.5x loan to income test on the banks. So they're stress testing the banks at the same time that they're stress testing consumers. And if it yields favorable results, their intended outcome is to either remove or reduce the stress test. And if you look at the Bank of Canada's most recent readings, the percentage of mortgages that have a loan to income greater than 450%, or that 4.5x test that we're seeing, is low. It's come down substantially since the pandemic. So my guess would be that the result of this probably will be favorable, and this is actually going to probably be the policy that will be most impactful in shifting buying power away from investors and towards first-time buyers, because first-time buyers will likely get if they completely remove the stress test, you get like a 10 to 20% increase in buying power overnight. I'm going to talk a little bit about interest rates and sort of the rate path. The reason I wanted to go through a lot of the things that I was just mentioning to you is because I think that the point here is that first-time buyers are they're really struggling to be part of the market, and we're likely to continue seeing this cultural shift towards rental, especially in at least Toronto, most likely the GTA. On the interest rate side of things, I just looking at sort of the forecast of what other economics houses and the bond market is saying. As it stands right now, we're seeing basically most people seem to be in agreement that rates are going to come down a little bit more, and then they're probably going to have to start going up towards the end of next year. The budget might have changed that outlook a little bit because the deficit was a lot smaller than we had originally anticipated, but the deficit could also still get worse than it's forecasted in the budget, which is what tends to happen. Your big 6 banks, similar outlook towards the end of next year. There's potential actually for rates to need to come up as a result of inflationary impact from government spending, the excess bond issuances from the government having to raise this capital, and the bond market basically pushing yields back up. This comes from Rich Diaz as well. An interesting point to note is that we sort of re-entered this area, this kind of like YOLO phase of central bank policy where you're in a negative real rate environment, which is when things really started to get unhinged post global financial crisis in Canada. The other thing that I want to mention is that one of the things that we look at really closely is mortgage arrears. And mortgage arrears, they're obviously at historic, they're not historic lows, but we're coming off of historic lows. But the year-over-year increases are substantial. And I'm not saying this to sound the alarm, because I think there are a lot of mechanisms in place that have kept mortgage arrears really low, maybe perhaps artificially low. Like if you're a big six bank, you like literally have to completely ignore them and like tell them that you want to go power of sale if you, if you want to end up having a forced sale. It's like very rare to see those mortgages. There's a lot of things that they can do to accommodate you. The two most important data points from my perspective, outside of like trade war, Kuzma, renegotiation, et cetera, which to me is really the X factor, and I just try not to get into it because it's a bit out of scope for me, is what's happening with unemployment and what's happening with the mortgage arrears. And it doesn't have to be just the unemployment rate, because employment level matters almost a little bit more right now in Canada because we have so many people leaving. That can skew our unemployment numbers if people are leaving the labor force, right? But your unemployment rate and mortgage arrears tend to track one another relatively predictably. And as it stands historically, we don't see markets start to turn around. And when I say turn around, I mean rent growth, I mean price growth, I mean increasing number of sales, until arrears stop falling and the unemployment rate starts to normalize. Home prices can sort of similarly track your mortgage arrears. Again, if we see more arrears, you get more. They're having a way better event over there than us. Sorry, guys. You start to get your house prices obviously have more downside risk if there's more distressed sellers, and distressed sellers are basically able to price discover downward more quickly. The other piece that I'll mention when you look at arrears is if you pull forward your arrears by 23 months and look at the sort of the rollover in your 5-year mortgage rate, which we're past, right? Our mortgage rates have peaked and we've started to come down. You can usually anticipate that your arrears start to taper off within 18 to 23 months of that. So the end is in sight, right? The light is there at the end of the tunnel. We just have a tough year to survive before we get there. All of this to say, and I love to do questions, by the way, or whatever. I went through that quicker than I thought. So I think that the GTA and Toronto's market is very much in a position where we, like the people in this room, mostly are going to be the housing supply creators probably over the next 2 to 5 years. We're not going to, maybe even longer, to be honest with you. Like I try not to get too bearish about it, but I don't see our sort of high-rise, very expensive, high total creation costs housing model coming back anytime soon. And this means that your smaller projects will be responsible for a lot of the supply that solves the problems that we just discussed in this deck here. And we've been doing that for the last little bit. It's not nearly as much, and this is the challenge that we're facing, right? How do we get to, you were building, 20 or 50,000 high-rise units a year. How do we get this missing middle world, this multiplex world to the same scale that we saw a lot of the high-rise development getting to? And those are the things that is important for me to think about right now. The other thing that I really want people to evaluate is that we are probably heading towards a renter's economy in the city of Toronto. And I don't think that's a bad thing at all, but I think that it's something that's very much worth forecasting for. The one opportunity that I'll say, and I know Ben talks a lot about this, is, and Matt, I know you've been mentioning, like you've seen a lot of terminations sort of happening in people condominiumizing plexes, right? And I think that this is one of those unique opportunities in the market where you're sort of falling in the middle of housing supply being too small versus too big. Again, that missing middle. You're being able to price it appropriately. You have a supply agility that these high-rise projects don't have. And so that's probably the one thing that fascinates me the most as an opportunity in the missing middle space right now, is actually building these projects as build to own rather than build to rent. I mean, the guys who were at my table before, we were talking about ways to fundraise in this space. You got 70,000 real estate agents that are looking for something to do. A lot of them used to sell pre-construction units, and that's how we used to fundraise for high-rise construction. I don't see why that model doesn't work for your smaller, more agile housing types. And so these are the things that I'm thinking about right now. I'd love to hear what you guys are thinking about, because I think how am I for time? I'm like 5 minutes ahead, 10 minutes ahead. So if you guys want to do any questions or whatever, I'd be happy to chat. I always love question period. It's my favorite. That's it. That's all I got for you. Yeah.